Hello traders, welcome back to the Forex Geek where we dive deep into the tool that can help you make smarter trading decisions. And in today's video, we are going to be talking about leading indicators and how they can transform your day trading strategy. Leading indicators are powerful tools allowing you to anticipate market movements before they happen, giving you a significant edge over reactive traders. So if you have ever struggled with late entries or false signals, stick around until the end of this video because you would learn a step-by-step strategy to use leading indicators effectively and boost your trading results. So don't forget that leading indicators are tools used to predict future price movement in the market, unlike lagging indicators which trends after they have begun. Leading indicators provide early signals of potential reversals or new trends. These tools analyze current price data to identify patterns, momentum shifts, or extreme buying and selling behavior, establishing traders or enabling traders to anticipate market changes before they occur. This may be particularly valuable for day trading or day traders who rely on quick decision making. So let's look at the types of leading indicators that we'll be making use of. The first one is the momentum indicator, which an example is the RSI. The RSI is one of the examples of a momentum indicators. It measures price momentum on a scale of 0 to 100. Value above 70 indicates an overbought condition, while values below 30 indicate an oversold condition. Momentum indicators highlight the rate of price changes, helping traders to spot accelerating or decelerating trends. Now, the second indicator we are going to talk about are the oscillators. An example of an oscillator is the Stochastic Oscillator, and this indicator compares closing price to the trading range over a set period. Readings above 80 signifies an overbought condition, while readings below 20 signifies an oversold condition or an oversold level. Now, the next indicator we are going to be talking about is the unbalanced indicator, an example of volume-based indicators. Now, this unbalanced volume indicator tracks cumulative buying and selling volume. This unbalanced indicator tracks the cumulative buying and selling pressure by analyzing the volume change relative to price movement. Not only that, we can make use of another volume-based indicator known as our accumulation and distribution line. Our accumulation and distribution line is another indicator we can make use of. This indicator combines price and volume. This accumulation and distribution, they combine both price and volume data to determine whether an asset is being accumulated or distributed. So these are the examples of the few volume-based indicators we can use for a leading indicator during our day trading. Then the fourth tool we can use are trend predicting tools. There are some trend prediction tools that we make use of. They can act as leading indicators. An example can be our Fibonacci retracement. Fibonacci retracement is an example of a trend prediction tool, identifying potential reversal points based on the key levels on the retracement tool. These key levels are areas where we expect price to reverse from. Levels such as our 38.20 level, our 50 level, and our 61.8 level. These are levels that act as leading indicators. When price gets to that area, you can anticipate that price is going to reverse from that area after you have analyzed your price action. Another indicator can be our pivot points that calculates key support and resistance level using highs, lows, close of price during the previous section. Now let's see how we can incorporate this into our day trading strategy. How we can incorporate our leading indicators. The first step is to analyze the market environment. Now you start by determining whether the market is trending or ranging, and for this we can make use of our ADX. We can make use of our ADX indicator to know if market is trending or ranging. And as we can see in this area, this particular area, we can spot that the market is trending to the upside. We have to see if the ADX value is above 25. If it's above 25, the market is trending, but once it's below 20, it is a ranging market. And at this area where the trend started from, we can see it is above 25, signaling we are in a trending market. So these steps ensures that you are using the right tool for your current market condition. The second step is to apply the right indicator. In a trending market, you use your RSI. You use your RSI to identify overbought and oversold conditions, and you have to confirm using your unbalanced volume to ensure that the volume supports the trend. So in this particular example, using our RSI, we can see that the market just is leaving our area of oversold condition, meaning that we are expecting a bullish trend. So combining this with our unbalanced indicator to confirm if volume supports that our trend, and we can see that the unbalanced indicator is trending to the upside, signifying that yes, it supports the trend that is about to occur. So by combining these indicators, it helps us to know the condition of the market. Now we can actually combine with our pivot points just to be able to spot our supply, our demand and supply areas, or we can say our key support and resistance areas in the market. These are the areas that we'll be looking at as key supply and demand regions in the market. So this is our areas of potential reversal. This is our resistance points and our support areas that is being shown by our pivot point. So these are areas that we should watch out for potential price reversals. The third step is to execute your entries. For a long position in an uptrend, you have to wait for the RSI to dip below 30. And as we can see, at this area on the RSI, it dipped below 30 at this region. As we can see, below 30 at this region, signifying an oversold condition, and we have to expect a potential uptrend. Then we'd have to look for, in a sell trade, we'll look for price to be above the 70. If I'm to look for a selling opportunity, I'll be looking for price to be above 70 to spot my overbought region and to expect a reversal in price. At this area, this is a typical example of above 70, where you expect price to reverse to the downside. Even if it was for a short period, this signifies that it is in an overbought condition expecting a reversal. That is how we make use of this indicator, the RSI, to spot the trends. Then we can confirm using our price action, because indicators alone are not enough, like in this area where the indicator showed that we should be expecting a reversal, if we did not consider the market structure at this area or the price action, we would have fallen for this trap. So we always have to analyze using our price action to know the overall trend. And as we can see, price is making a series of higher highs, a series of higher high, a higher low, a higher high, a higher low, a higher high, showing that we are in an uptrend. So this is how we capitalize on using price action. We can also make use of our Fibonacci retracement levels for areas we expect price to reverse from. By drawing it from our swing low to our swing high, looking at this area, we can see price reverse from our 61.80 level. This confirms that price is going to respect this level after confirming the overall trend and the direction of the market with our other indicators, with our leading indicators. So this is where we would be looking to enter our trade at this area, or you can make use of your pivot regions, your pivot zones. So after confirming with our RSI to see the overall trend, confirming with our unbalance to support the trend, we would enter our market using our Fibonacci retracement level at our 61.80 level. This is a perfect area to enter. So at this particular area you enter your market, you would have to manage your trade. You have to manage your risks appropriately by setting your stop loss just below the previous swing low in an uptrend. And if it's in a downtrend, let's assume we took a trade from here, to save ourselves from any losses, we would always put our stop loss above the previous swing high region. This is basically how you manage your trade. In a long trade, you place it below the previous swing low. In a downtrend, you place it above the previous swing high. Now, how do we exit our trade? We exit when the indicator shows a sign of reversal. We can use our RSI for this. When our RSI gets below the 50 region, or we can use our unbalanced indicator when we see there is a change in the volume, or we can see the volume is not showing a direction, is moving sideways. This will be a good area for you to leave your trade. At this area where you see the volume, the unbalanced indicator is squeezing, this can confirm that price is not making a significant move in the market. So this is how we can exit our trade. You can use either your RSI, your unbalanced indicator, or you can make use of your stochastic oscillator. You exit the moment price falls below or is falling below the 50 region, signifying that we are coming into a selling market. Or when your stochastic oscillator crosses to the opposite side, when you see a crossover in your stochastic oscillator indicator, this signals an opportunity for you to leave the trade. Now let's see if we can get a different example. Now for a selling scenario, we first of all confirm the trend by using market structure. And as we can see at this area, price is trending to the downside. We can also confirm the trend using our RSI, and as we can see in this area, price is trading above the 50, the 70 region at this area. We can also use our stochastic oscillator to see if price is above the 80 region. As we can see at this area, price is above the 80 region, signifying we are expecting a downtrend. And when we confirm this downtrend, we can use our Fibonacci retracement to get an area of reversal. And as we can see, price still respected the 61.80 level. This would have been a good opportunity for us to enter a short trade at that area. Remember, your stop loss should always be kept at a previous swing high position in terms of a buy sell trade. So we put our stop loss just above the swing high, and we ride this trend. Where we will exit our trade is when we see a crossover in the stochastic oscillator, or when we see our RSI indicator is going back to the oversold region. At this area would be a good place for us to exit our trade, because it means that price might reverse or move to a sideways moving market. This is how we can capitalize on using leading indicators for our analysis and to use them for our day-to-day trading lifestyle. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, do not forget to like, subscribe, and turn on the notification bell so that you wouldn't miss out on more trading tips and strategies. Thanks for watching, and I will see you in the next video.